Hey everyone, ready for another deep dive? If you're even a little curious about what's shaking up the markets today, well, buckle up, because we're breaking down a wild ride. Our main source is PantheonAI's financial briefing, hot off the press from today, December 19th, 2024.
And it's definitely a day for some market drama. But here's the thing, even if you aren't someone who's, constantly checking stock prices, these market swings actually matter for pretty much everyone.
They do, they totally do. And PantheonAI doesn't sugarcoat it. They're reporting some serious drops across major U.S. indices. I'm talking about the S&P 500 taking a nearly 2.9% nosedive. It closed at 5,872 points.
Yeah, that's a big one to watch. And it's not alone. We've got the Dow Jones Industrial Average that tracks 30 major companies, also down, closing at 42,326 points, a drop of 2.6%. These indices, you can think of them as like a thermometer for the U.S. economy, and right now, there's definitely a bit of a chill in the air.
Brr. Yeah, I'm feeling it. And then there's the Nasdaq, that tech-heady index. Ouch. It got hit even harder, down 3.5%, closed at 19,392. And let's not forget the Russell 2000. That one focuses on smaller companies, and it got slammed with a 4.7% drop, closing at 2,231. So what's the culprit behind all these declines?
Well, investors are juggling a lot of question marks right now, but one thing seems to be rattling them more than anything else. It's the Federal Reserve, the Fed's latest announcement about interest rate cuts.
The Fed, always making waves. Break it down for us. What did they say, and why is everyone so on edge?
Okay, so the Federal Reserve, the Fed, they're like the big boss of U.S. interest rates. They set the pace for how much it costs to borrow money, whether you're a business, a homeowner, looking at mortgage rates, the whole 9 yards.
Right, they're the ones calling the shots.
Hmm.
So what did the big boss decide this time?
They're pumping the brakes, at least a little bit. The announcement is that they'll be slowing down interest rate cuts next year. Now, I know that might sound kind of technical, but what it signals loud and clear is that they're worried about inflation. It's like tapping the brakes on the economy, and investors, well, they don't always like surprises.
Uncertainty is definitely a recipe for jitters in the market.
Absolutely. When the Fed starts moving cautiously, investors start second-guessing their moves, too. Concerns about future economic growth, worries about company profits taking a hit, that all leads to sell-offs, exactly what we're seeing.
So with all these major indices in a downward spiral, you'd think everything would be feeling the pain, right? But, plot twist, crypto's actually doing its own thing.
You caught that, didn't you? Yep, there's a twist in this story. Bitcoin, up 1.8% today, hitting $101,986. And Ethereum's joining the party too, up 1.4%, reaching $3,678. Pretty unexpected when you see how traditional stocks are getting hammered.
So what makes crypto seemingly immune to this market-wide downturn? That's the big question, isn't it?
$1 million question for sure. We often think of crypto as the riskier investment, the volatile one. But it's holding strong when traditional stocks are faltering. One theory. Some investors might see it as a shield against inflation, especially with what the Fed's saying. They might be thinking, hey, if the dollar's losing value, maybe Bitcoin can weather the storm better.
Like a digital lifeboat in a sea of economic uncertainty. Interesting.
Could be. Or it might just be investors looking for places to park their money outside the usual stock market. It's a fascinating divergence, that's for sure. Definitely something to keep an eye on.
Speaking of things to watch, let's talk oil. PantheonAI mentioned a potential perfect storm brewing. What does that mean for oil prices, and should we be worried?
Oil prices, they're like a barometer for global demand. Right now, we're hearing some analysts say that big economies, China, Europe, they could be headed for a slowdown. If that happens, demand for oil plummets. PantheonAI is even suggesting we could see oil prices below $50 a barrel by 2025.
Whoa, below $50. That's a steep drop.
It is, and even if you don't own an oil rig, it matters. Cheaper oil usually means cheaper gas. Great news for drivers. But it can also hurt energy companies, even lead to job losses in that sector. It's a mixed bag.
Winners and losers.
Right.
All depending on how this unfolds.
Right. It's a complicated web, and it just shows how what happens in one part of the economy can ripple out and touch all of us.
PantheonAI also highlighted some research from Citigroup about past pauses in Fed easing cycles. These pauses, they say, have often spelled market volatility. Is history about to repeat itself?
Well, Citigroup's research definitely shows a link between Fed pauses and those market jitters. Investors tend to get a little jumpy when they're not sure what the Fed's next move will be, like trying to read tea leaves, And this time, there's even more uncertainty with that January rate change looking less likely.
So everyone's in wait-and-see mode, which for markets usually means holding their breath. It's amazing how decisions made in Washington can have a ripple effect across the globe. What about other markets? How are they reacting to this whole situation?
It's a global dance, everyone watching each other's steps. We've got the Japanese yen taking a tumble after the Bank of Japan's Governor Ueda made some comments. And the Bank of England, they've decided to keep interest rates steady for now. All these moves are causing some serious ripples in currency markets around the world.
It just goes to show how interconnected the financial world really is. What happens in one corner of the world can have a big impact everywhere else. Let's zoom in on specific sectors now. How are different industries being affected by all this turmoil? What are the potential risks and opportunities for our listeners? Let's start with technology, always a hot topic.
Tech has definitely taken a hit in this downturn. Investors are worried about those rising costs for tech companies, especially with inflation on everyone's mind. Plus, there's more scrutiny from regulators, which just adds to the uncertainty.
So even though tech is often seen as a growth sector, right now it's facing some pretty strong headwinds.
That's right. And the energy sector's in a similar boat, dealing with that potential demand collapse we talked about earlier. And then there's the shift towards renewable energy sources, putting pressure on those traditional energy companies. They have to adapt, and that's not always easy or cheap.
And what about the financial sector? How are banks and financial institutions handling the Fed's moves?
Well, the Fed's actions on interest rates are putting a squeeze on bank profits. You see, the yield curve, that's basically the difference between short-term and long-term interest rates, is flattening. This shrinking difference makes it harder for banks to make money from lending, which is their bread and butter.
So tough times for the financial sector as well. But amidst all this doom and gloom, are there any silver linings? Any potential opportunities for savvy investors to come out on top?
Absolutely. Even in volatile markets, there are always opportunities. The key is to be strategic and diversified in your approach. Take the tech sector, for example. Even though it's facing challenges, it still has that long-term growth potential. Innovation in tech never stops, and those companies that can adapt to the changing landscape, they're likely to thrive in the long run.
So don't write off tech just yet. What about other sectors with potential?
Renewable energy is definitely worth a look. As the world shifts towards sustainability, demand for clean energy solutions is only going to increase. Companies focused on this transition, they're well positioned for future growth.
That's encouraging. Even with all this market chaos, there is some bright spots for those who know where to look.
Exactly. It's not about panicking. It's about understanding what's happening and making informed decisions. Diversification, careful research, and a long-term perspective, those are your best tools for navigating these uncertain times.
It sounds like we've covered a lot of ground already. We've seen how U.S. markets are reacting to a more cautious Federal Reserve, those potential global economic slowdowns, and yet crypto's showing some surprising resilience. We've seen how different sectors like tech and energy are facing challenges, but also offer potential for growth. Now let's shift gears a bit. Let's talk about how you can actually navigate this market roller coaster.
That's the key, right? Knowing what's happening is one thing, but figuring out what to do about it, that's what matters.
Exactly. So where do we even begin? With all this talk of economic slowdowns, market dips, it's easy to feel kind of overwhelmed.
Oh, absolutely. And that's why it's so important to approach investing with a clear head and a solid strategy. And one approach that's particularly relevant in times like these, volatile times, is diversification.
Diversification. It's a word you hear all the time in the financial world, but can you break it down for us? What does it actually mean in practice?
Okay, think of it like this. You wouldn't put all your eggs in one basket, right? Diversification is basically that same idea, but for your investments. Instead of putting all your money into one asset class, like just stocks, you spread it across different types of investments. Stocks, bonds, real estate, even things like gold.
So it's like a financial safety net. If one investment takes a hit, the others can potentially cushion the blow.
Precisely. Diversification helps to reduce your overall risk. For example, if the stock market is having a rough time, your bond investments might hold their value, maybe even go up, helping to offset some of those losses.
Okay, that makes sense. But how do you actually go about diversifying your portfolio? It sounds a little complicated.
It can be as simple or as complex as you want it to be. One approach is to invest in mutual funds or exchange-traded funds, ETFs. Those funds pool money from multiple investors and invest in a diversified basket of assets. It's an easy way for individuals to spread their risk without having to become stock-picking experts.
So instead of trying to pick winning stocks myself, I could invest in a fund that covers a broad range of companies, maybe even different asset classes altogether.
Exactly. That's one of the big benefits of mutual funds and ETFs. They provide instant diversification. You don't have to be a stock market whiz.
That definitely sounds appealing, especially for someone who's, not a financial expert. But what about those who prefer a more hands-on approach to their investments? How can they diversify effectively?
For investors who like to be more involved, diversification can also mean selecting individual stocks across different sectors. So, for instance, you might invest in a mix of technology, healthcare, consumer staples, energy companies, that kind of thing, to create a balanced portfolio.
So even within the stock market itself, there are ways to spread your risk and potentially benefit from growth in different areas of the economy.
Absolutely. Sector diversification makes sure you're not overly exposed to the ups and downs of just one industry.
Diversification, it definitely seems like a smart strategy, especially given all the uncertainty in the market right now. Are there any other important things investors should keep in mind as they navigate these choppy waters?
Yeah, another crucial factor is your risk tolerance. This basically means understanding how much risk you're comfortable with, how much fluctuation you can handle in the value of your investments.
So it's like knowing how much of a thrill seeker you are, right? Some people love roller coasters, others prefer a nice, smooth walk in the park.
I love that analogy. Your risk tolerance depends on a lot of things. Your age, your financial goals, how long you plan to invest your money. Someone younger with more time might be okay with higher risk investments, those that could have big returns. But someone closer to retirement might prioritize protecting their savings, going for lower risk investments.
Like choosing between that roller coaster and the leisurely stroll, right? Your risk tolerance determines which ride you're willing to take.
Exactly. Once you have a good grasp of your risk tolerance, you can tailor your investment strategy to match. If you've got a higher risk tolerance, you might put a larger chunk of your portfolio into growth stocks or maybe emerging markets. If you're more risk averse, you might focus on those more stable investments like bonds or dividend paying stocks.
This is starting to make a lot of sense. But let's get down to brass tacks here. Can you give us some concrete examples of how these strategies might play out in today's market, considering everything we've been talking about?
Sure, let's say you're worried about rising interest rates hitting the financial sector. You might decide to reduce your exposure to bank stocks and shift some of those investments to companies that actually benefit from higher interest rates, like insurance companies. Or, thinking about the downward pressure on oil prices, you might reduce your holdings in those traditional energy companies and start exploring opportunities in the renewable energy sector.
So it's about being adaptable, adjusting your sales based on the wind.
Exactly. It's like sailing, you got to adjust to the conditions. And remember, investing isn't about timing the market perfectly. It's about time in the market. Consistent long-term strategies, those tend to yield the best results.
Okay, I'm definitely feeling more confident about navigating these turbulent waters now.
So,
Any final words of wisdom for our listeners who might still be feeling a bit seasick from all this market volatility?
the most important thing, don't panic, stick to your investment plan, make sure your portfolio is diversified, and stay informed. Market downturns, they're a natural part of the economic cycle. They can be unsettling, but as we've discussed, they can also present some real opportunities for those who are prepared.
Great advice. It's like that old saying, buy low, sell high.
Exactly. Times of volatility can create opportunities to buy assets that are undervalued. But remember, do your research, make informed decisions, don't just blindly follow the crowd.
All right, we've covered a lot of ground in this part of our deep dive. We've explored the importance of diversification, understanding your own risk tolerance, and adapting your strategy to what's happening in the market right now. But the journey's not over yet. We've talked about those big picture strategies, but sometimes you need that more personalized touch. So we've got a special guest joining us today, someone with years of experience helping people navigate all kinds of market ups and downs. It's guest speaker name, a financial advisor. Welcome to the Deep Dive.
So glad to have you join us.
Thanks for having me. Happy to be here.
We've covered diversification, risk tolerance, staying informed, all super important stuff. But for someone listening who might be feeling a little lost right now, what's the one thing you'd tell them? How can they actually put these strategies into action?
When the market gets rocky, the biggest mistake I see is people trying to, time the market perfectly. It's incredibly tough, even for the pros, to predict those ups and downs with any real accuracy. My advice: focus on what you can control, and that's your long-term investment plan.
So crucial, right? It's about that plan, sticking to it, not letting your emotions run wild when things get volatile.
Easier said than done, though, am I right? Those headlines about market crashes, they can really get in your head.
Oh, absolutely. Fear and greed, they can mess with our judgment. That's actually one of the biggest advantages of working with a financial advisor. They can be that objective voice, help you stay the course, avoid those impulsive moves that can really hurt you down the road.
Like having a guide, right? Someone to help you through the wilderness.
More than just someone to talk to, though. A good financial advisor gets your goals, your risk tolerance. They work with you to create a plan that's actually customized, not just some cookie-cutter template.
It's tailored, not one size fits all.
Exactly. Your financial plan should be as unique as you are, and it's not static. It's something you revisit as your life changes, as your goals evolve.
Got to be flexible. So let's say someone's listening and thinking, okay, I need some help. Where do I even start looking for an advisor? Any tips on finding the right fit?
First things first, look for a fiduciary. What that means is they're legally obligated to put your best interests first, that's key, and make sure they've got the credentials, the experience to handle your specific needs.
Don't be shy about asking questions. How are they paid? What's their investment philosophy? How do they communicate with clients? It's like any relationship. You want a good connection.
It's about trust, transparency.
Exactly. And remember, you're in charge here. You choose the advisor you feel good about, someone you believe can help you reach those financial goals.
This has been so helpful. Any parting words of wisdom for our listeners before we wrap things up?
Don't let those market ups and downs derail you from reaching your goals. Stay informed, stay focused, and remember, even in uncertain times, there are opportunities out there.
Love that. Guest speaker name, thank you so much for joining us. Really appreciate your insights.
Happy to be here.
Thanks for being with us.
Well, there you have it, folks. We've reached the end of our deep dive into market volatility and the opportunities that can emerge even amidst all the turbulence. We've explored the forces at play, those key strategies, diversification, risk tolerance, even heard from a seasoned financial advisor. Remember, it's not about predicting the future, it's about being prepared. Keep learning, keep exploring, and keep those questions coming. Until next time.